Hello traders, it's Saturday, January the 18th. This is John Kicklighter, Chief Strategist for DailyFX.com, here with your FX market wrap-up for this past week and an outlook for what we can expect in the week ahead of us. This past week, if I had to wrap up in one general assessment, a quick assessment, I would say that taper speculation has returned, that the competitive monetary policy expectations for the Bank of England and the ECB have actually turned a little bit more hawkish than what they were previously, and we still see a drifting of the Bank of Japan's intentions, though we are coming up on a BOJ rate decision in the coming week. And, of course, the ever-looming risk trend theme has yet to truly kick in. All right, that is a summary of the conditions that we had this past week, and that is why we've had or why I'm so interested in the very remarkable break that we had into the end of the week. Now, I talked about the breaks, or the weekend breaks. Actually, there are a number of them. I would say 3 or 4 in the weekend strategy video. So you can check out that and the conditions that I usually look for when I'm taking or deciding against a trade on a attractive technical development like this. But the real interest for me on this Euro USD. All right, I'll talk about the technical, fundamental, and market conditions because this is a very important pair, and it really taps into risk trends and the depth of those risk trends, the relative monetary policy outlook, and, of course, general trading conditions. With the technical view, this is an 8-hour chart, but you can see that we have cleared from the floor, or cleared the floor of this rising trend channel. So that is quite a notable technical break. Yes, it does have 1, 2, 3 tests. I need 3 tests before I can call a trend line a trend line. Otherwise, it is not a valid trend line in my book. I see too many lines being drawn on 2 points. All right. A line can be made out of any 2 points, but just 2 points does not necessarily make it relevant. That's why we can see a point here and a point here. Doesn't necessarily make it relevant. So we need that third confirmation test. That did come in indeed. And this is a general turn of a failed move above 138.50, 139, which was over the really, really thin trading conditions at the end of the year, and a reversal from much larger resistance. All right, so this is a very technically progressive turn and very encouraging. The problem is I'm very dubious of the follow-through. All right, the follow-through, if we look at fundamentals and market conditions, is really lacking. So this Euro USD, you can see simply through the trading patterns that we've had as of late. All right, I don't even have to reference back to market conditions in terms of volatility. All right, or I can look at volume, the participation level of the market, which we have right here. These kind of conditions are not conducive to the kind of breaks with follow-through necessary. I know we're looking at the S&P 500, but this is a good benchmark for general market conditions. All right? And if we're not able to find the most prominent, if not liquid, equity index out there, then what hope does the most liquid and active currency pair have? All right, these are not the kind of conditions I want to see. Now, of course, I can just look at the price action we've had over the past weeks and months, and you can see that the development, the progress that we've had, has been very lackluster. A lot of this chop, a lot of back and forth. So, taking a trade into the end of the week, expecting that conditions will all of a sudden change, seems a little bit unreasonable. All right, so this is a trade that I did not take, although I've been waiting for this development for some time. A further concern that I have, and something that I'm going to have to take into consideration next week as we start to talk about this as a possible trade setup, all right, as the new week rolls around, one of the first concerns that I'm going to have is the development or the progress of the relative monetary policy scheme. Now, I've said 2 general trading themes that we must keep in our view. One is underlying risk trends. That is not giving us progress, and in general, the Euro USD is not very sensitive to that immediate ebb and flow. We need to see a very consistent, a very clear drive towards risk aversion before the Euro USD really starts to take to that theme. All right. Not necessarily the same kind of circumstances if we were looking at something like a dollar yen or really any other yen cross. Kiwi yen, for example, which has a tentative break of this longer-term wedge, multiple-month wedge formation. So when I look at a Euro USD, all right, the risk trend consideration is not very prominent. It has not made a move. And do I necessarily expect a risk trend? Not really. Why? Well, one, because on Monday we're going to open up to a U.S. market holiday. Now, I know the U.S. market is not the only market out there. In fact, through the North America and South America session, there are actually a number of markets that will be open. However, this accounts for one of the greatest sources of liquidity, speculative liquidity, globally. So disrupting that flow of one session to the next with full liquidity and full speculative endeavor is often a recipe for dead markets. All right. So with the break that we have there on Monday, this is likely to be a lackluster development on risk themes. My other concern is that later, not this coming week, but the week after, that's when we start. That's where we actually get to the Fed's next rate decision. All right, the Wednesday after next, January 29th, Bernanke's last meeting, and a heavy speculation of the next taper. All right, that has very good potential of being a catalyst, a driver for risk, but it also is a very prominent theme for the U.S. dollar. This past week, we've seen that taper speculation pick back up, especially with the policy officials, dovish to hawkish, have all suggested that a continuation is most likely. That essentially continuation of taper is the default pace that they're going to take. All right, so you have to actually see something that prevents them from tapering now. Now that would be a very encouraging thing, and certainly it has helped out the U.S. dollar. We have seen the progress through this week. All right, a nice 4-day rally, a very good 4-day rally. We don't see very many of these, and this one certainly brings us back up to 4-month highs, and also, if you will, a nice 61.8 fib of this initial July to October swing low. So we are making some very good progress for the dollar in that taper speculation and the impact that it has with bolstering shorter-term yields like 2-year and 10-year government bond yields. That is going to make the U.S. dollar look a little bit more competitive, actually significantly more competitive. When we see those kind of competitive rates, it starts to influence interest rate forecasts. And though we might not have that first rate hike until well into the future, we must remember these are forward-looking markets. And knowing that later down the line, the Fed is going to hike its benchmark rate potentially earlier than, let's say, the ECB. That is an encouraging drive. The only problem with the Euro USD is on this scale is that the ECB this past week has seen a number of conditions that suggest that the ECB is not going to take that hard stimulus turn. So after the ECB unexpectedly cut rates back in November, we did see speculation run rampant on expectations that a big stimulus program would follow up with that rate cut, so something like a targeted LTRO program. However, we've seen this past week a couple of ECB officials have suggested that they don't expect a stimulus program, a stimulus-like program. All right, they say it's not needed. And we've also seen the market rates for different periphery bonds. All right, so periphery, we're typically talking about those countries that were bailed out via the Troika lines. So we're looking at Greece, Ireland, Portugal, and the Spanish banking sector, so Spain falls in there as well. Well, look at the Spain and Italian 2-year yields. All right, these have dropped to record lows. We've been following this, but this is a sign of not a robust return of growth, because we know that Spain is looking at over a quarter of its population, or at least its labor pool, is out of work. All right, Italy is sporting the largest deficit load in the European area. All right, there is very little reason to suspect the kind of conditions, the kind of health that we are seeing here. What we're seeing is the same kind of circumstances that have supported the S&P 500. All right, are we seeing exceptional growth? Are we seeing very high rates of return? Are we seeing the kind of investment conditions that would encourage people to buy now because they have greater opportunity down the line and they will benefit from it from getting in now? No, they don't. All right. This is a buildup of speculative endeavor. This is an appetite for yield, an appetite for return. And in a market where global returns are exceptionally low, you have to fight for whatever rates of return you can get, wherever you can get it. And one of the places that we can get it is in Greek government bonds, or Spain and Italian government bonds. But these are very much an investment flow, just like what we see in the S&P 500, just like what we see in the high yield debt, the corporate bonds, and all these other riskier assets. Just as exposed to volatility, but whenever that volatility comes through, that's when it becomes a concern. But realistically, I think that the ECB acts a little more preemptively than we see a financial crisis lead this. Let's hope that it doesn't come to that, because we would generate a lot greater volatility, a lot more whiplash from the Euro USD. So conditions actually from the monetary policy front actually improved for the Euro this past week. So we see this drop from the Euro dollar, and that's a little bit dubious. We see the drop from the Euro pound, right, to the bottom of this very massive wedge formation. This is actually a daily chart, all right? Very dubious, right? Because conditions actually improved. So something like my Euro Kiwi, which is the only trade I'm holding into the weekend, to the long side, carry has been eating me alive, but it still has a good potential when we're seeing it play off of this technical pattern, and because the Euro itself and its conditions have improved a little bit. Not saying that they are exceptionally robust, but the problem, the negative outlook for yield and rate forecasts for the Euro has diminished. So that is in turn a better forecast for the Euro. So that is yet another condition that I'm going to have to consider into next week for the Euro USD with this very prominent breakdown. But this isn't the only currency that has made a significant change. Actually, I think that monetary policy expectations for the British pound have substantially altered. All right, I've been very concerned about the outlook for the pound and its exceptional performance. It's not just strong against the U.S. dollar; it's been strong really against all of its counterparts for the past 6 to 7 months, and it's done so because we've seen the Bank of England abandon any kind of threat to expand its stimulus program. All right, that put it in a very favorable position when we're talking about relative monetary policy, and the rate forecasts that offers us is a bullish condition for the British pound. But that is overdone it. I think that the market is looking for a hike sometime in 2014, but the Bank of England's own forward policy guidance has said 2015. We're not moving until 2015. We're not hiking until 2015. We hit the 7% unemployment target that we offered. We still might not hike. All right. Some policy officials have said this, but this past week we've seen, especially with the Bloomberg UK economic forecast, market participants think that they're going to change that forward guidance when they offer an update in February. All right, so obviously speculation is running rampant for the British pound, and that was a good driver through the intraday patterns. Generally, when we have a market that is not very conducive to breakout, so we look at something like the dollar, or we look at something like the S&P 500, which are more attuned to congestion, though they're both sticking with their prevailing trends, but they're more congestive than breakout and follow-through ready, then I like to sometimes turn down the scale or the time frame of my charts. So something like this pound dollar, which had a nice break to the upside through these multiple wedges, all right, that's a good short-term trade. This wedge took an entire day to set up, or entire 4 days to set up, and with that kind of setup, the subsequent breakout would take around a day or 2 days. Well, that was perfect timing for the development that we had. All right. Now, some people equate this is actually quite a remarkable move from the pound dollar, and it actually contributed heavily to the euro pound. The necessary pressure to offset the euro's own stabilizing influence. This is going to be a fantastic fundamental trade setup next week, so we'll keep a very close eye on this one. But so will the pound dollar as it turns into this congestion, whether it lacks for follow-through and progress and is thereby a range trade, or maybe we start to see some of these interest rate forecasts between the US dollar and the British pound develop, then we can see something much more substantial, and I am waiting for this to make some progress. But In the meantime, the shorter term conditions that we were looking for, a nice break to the upside, and it played out within the time frame that was necessary. All right. With the pound, whether you're trading pound dollar, whether you're trading euro pound, to a lesser extent, actually a similar extent, pound Kiwi or pound Aussie, which had a very dramatic break to the upside where the euro Aussie was unable to follow, and maybe even the pound yen. If you are looking for sterling-based event risk, you got to be careful. If you're trading a sterling-based pair, you got to be careful. The opening 24 hours is quiet, as it is with really the broader spectrum of market sessions. But when we get into Tuesday, that's when things start to take off. We have a couple Bank of England speakers. We have manufacturing and business sentiment. All right, and then Wednesday is when we hit the pinnacle of that event risk, and that's going to be in the employment data. All right, remember the Bank of England is looking for a 7% target for unemployment, so this can be an important event. But also the Bank of England minutes, giving us insight into the Bank of England's last rate decision, which they did not move, and thereby did not give us an update because they wait for the minutes. We'll see what they were thinking and what their expectations are going forward with this particular event. All right, these are going to be very important for the British pound, and if we see anything that refutes those increasingly aggressive interest rate forecasts, be very careful. Euro pound will hold this floor and push back up to the upside. Pound dollar can move back down to its range floor down here at about 163.20, and then maybe even break 162.50 and really start showing progress, because when you measure up the pound versus the US dollar, risk aversion is better for the pound dollar, though it's not as aggressive as others. It certainly is supportive. And when we're talking about monetary policy, we really refocus our expectations there. Taper, right? Taper. The dollar is going to benefit from taper speculation as it continues to build up, especially as it recovers from that big slip after the non-farm payrolls disappointment. All right? So keep your eyes peeled for the pound dollar and other pound-based pairs. They have great potential, and you can even get scenarios where risk aversion kicks in and the pound gets hurt. That would be a tremendous drop-off for the pound dollar. All right. Now, Aussie dollar was another one of the breakouts that we talked about in today's strategy video. This is a continuation. In general, the Aussie dollar is getting slammed. All right, but there is a difference. There is a trade for the Aussie dollar next week, whether we're talking about continuation of Aussie dollar selling or we're talking about a stabilization and rebound for this Aussie dollar. Now, if we do see the Aussie USD stabilize and rebound, I'm probably going to be looking for an opportunity to get short at a higher level on this pair. I do think that this is a very good short side move, just like I think that the pound dollar to the short side has great potential over the medium term. We went into depth about this yesterday in the strategy or the trading video. The conditions that we're talking about. What about risk appetite? Aussie USD. When we look at its chart, all right, over the past 2 months, all right, this is the performance we get. Let's look at the S&P 500, a good benchmark for risk trends over the past 2 months. All right. The correlation could not be further off. So a risk-on theme does not necessarily help out the U.S. dollar. Meanwhile, risk aversion certainly does hurt the Aussie USD. And if we're talking about a look towards monetary policy, the expectations for the RBA to potentially cut are still there. I think it's a little aggressive, but they're still there, and we have to go with what the market says. Meanwhile, the taper expectations are solidifying. All right, so this is one of those unique circumstances where most of the major fundamental scenarios line up. The only offset would be if interest rate expectations really start to pick up from the RBA, which would be quite surprising. But you do have some scheduled event risks that you have to be careful of when it comes to the Aussie dollar. We have Australian CPI, which will be of particular importance on Wednesday. Also, beware of the relationship to China because we have the 4Q GDP. Given all the conditions that we have, these can also be very dramatic catalysts for an unwinding of Aussie dollar longs. So that is also that circumstance. But I said, whether we're going into next week, I have the potential to go for a trade of Aussie dollar regardless of what happens. Now, continuation to the downside is my preferred bearing here for the Aussie dollar, but I actually have a appeal for a positive Aussie trade. That's the Aussie yen. All right. If risk conditions stabilize, we are coming to the floor of this larger wedge pattern. 1, 2, 3 general tests. So this is a confirmed trend line for me, or at least by my definition. And we are coming right into the bottom of that floor. That gives us good support. All right. Now, with the Aussie yen, like most other yen crosses, these pairs move in relationship to each other. There is a high level of correlation between these pairs, as why you've seen this consistent move to the upside amongst all of them. Of course, the Aussie yen is lagging, but its correlation is still relatively strong. So if the dollar yen, all right, continues to drive forward, and the pound yen and the euro yen make similar efforts, then the Aussie yen is going to potentially do the same thing. All right, you have to be very careful of the yen crosses, because also on the docket for this relatively busy week for data, we have the Bank of Japan rate decision. All right, one of the reasons that this yen cross has stalled and not been able to follow through, because a taper expectation and stable risk trends should be enough for the dollar yen to continue to march forward. But one of the problems is that the yen has stabilized and started to rebound a little bit, because the market is once again concerned about when and if the Bank of Japan will actually act. Okay, because they are expected to introduce a upgrade to its open-ended stimulus program from last April, but it's still a ways off. In the meantime, we do have this rate decision. Will they start to talk about that rate upgrade that they're going, or the stimulus upgrade that they're going to do? If so, that can help these yen crosses extend their rebound. And Aussie dollar, as negative as its interest rate outlook is, we're competing for influence of monetary policy. It's not going to be the Aussie dollar that wins out. It's going to be the Japanese yen. All right, because as we know that the RBA, it might be at the very dovish level, but it really can't go any further. The Bank of Japan can with that QE2 upgrade that they're expecting. I just like to call it QE2. It's really open-ended stimulus program expansion. All right. So Aussie yen is another very interesting one. Of course, I have my pick of the litter if there is a risk aversion move that draws down all the yen crosses, because expect a QE upgrade or not, risk aversion led by equity indexes from all over the world. All right. That was the U.S. S&P 500, the Japanese Nikkei 225, and this is the FTSE 100 UK index. If we have risk aversion, Aussie yen will break this floor. All right, dollar yen will make its dive. Euro yen and pound yen are perhaps the most fundamentally exposed in that kind of circumstance. But the Kiwi yen has the prettiest of the technical developments with this break of this larger wedge. I absolutely must have a risk aversion theme, all right, or I need a very clear and significant reason to be short the New Zealand dollar, because if I don't have that, the New Zealand interest rate forecast is exceptional. Meanwhile, the Bank of Japan is expected to upgrade its stimulus program. All right, these are two very different bearings, and they are on the opposite ends of the interest rate spectrum. And we do have New Zealand CPI data due Tuesday morning New Zealand time and evening in the Western Hemisphere. All right, so there's some potential there, but as attractive as that technical bearing is, it does not have the fundamentals. Outside of these themes, all right, monetary policy and risk trends, keep your eyes on some of these other developments. Dollar CAD, all right, just like Aussie Kiwi. These are related currency pairs. They're trade partners who have a tendency to be very consistent in their trend. We talked about Aussie Kiwi to a significant extent yesterday, particularly in the strategy video. All right, if you haven't seen that, I recommend it. This is actually one of my top trades for 2014. You can also look at pairs like Euro Pound, all right, where we really start to highlight what really is the differential. Not necessarily just risk trends or one of these outside systemic considerations, but how one country or region is doing relative to the other. All right, it's good to be up to date on how these are moving. And the last thing I want to look at is a quick review of the commodity market, and namely we had gold and oil. Oil has had a nice bounce into the end of this past week, but it was gold that is quite remarkable because we did have, as we saw, a rebound in the US dollar. Now, typically the relationship between these two is negative, right? So when the dollar rises, gold typically falls, and vice versa. Well, gold rose, so did gold. Right, or dollar rose, so did gold. We are back up to this general range top here at about 1250, 1255, and this is a interesting effort, but will it find follow through? Not really. Not unless you have a fundamental reason to really push it forward. And that's the same kind of circumstances that we have put down for the Euro USD. That's the same kind of circumstances that we've put down for pairs like the Kiwi Yen. All right, they have clean, clear, and nice breakouts. I don't even know if we can call the gold move a breakout, but follow through is where we really make our trades. All right, and certainly with these, where we are apt to try to project trends. All right, counter trends going against the prevailing winds is even more difficult to develop than just seeing a continuation. Remember that. All right, we'll wrap it up there. Some interesting stuff next week, but remember this is kind of a lull before we get back to the taper conversation, get that next Fed rate decision. But do be aware we have Chinese GDP, we have a couple policy decisions, most importantly the Bank of Japan rate decision, and a number of other top-tier event risks that are good for volatility and certainly for defining our fundamental expectations. So be ready to trade once markets open on Monday. But until then, I hope you have a fantastic weekend, and we'll wrap up these markets once again next week.